Hi dear students, all are in the final lap of preparation. I know that all are busy with the studies and all, so this video will be a little help for you. So this video covers the important PYQs from block number 3 and 4, and these questions and answers are covering in 2 videos. Okay, so before getting in the video, we have already uploaded block 1 and 2 important PYQs and answers. Please go through it. If you like the content, please like, share and subscribe the channel, and if you have any comments or suggestions, do post it. So without further ado, let's get started. The important questions from these 2 units include what is international liquidity, then non-banking financial intermediaries and the difference from banking, and then objective of IMF, liquidity problem, how the IMF is solving the liquidity problem, then special drawing rights, development bank, NAVBAR, agriculture credit, salient features of regional rural bank, role of industry, then foreign exchange market, then objectives of World Bank, balance of payment, state financial corporation, LIC of India. So these are some of the important questions from these two books, right? Okay, so before getting into these questions in a detailed manner, this thinking code, please go through it. That is, thinking is the capital, enterprise is the way, and hard work is a solution. So the only solution to attain your goal is hard work. Please do it. Okay, with that note, we will get started. The first question from this section is, what do you mean by international liquidity? Discuss various proposals to augment the supply of international liquidity. So international liquidity refers to the gold and foreign exchange reserve position at international level. The balance of payment disequilibrium along with the lack of multilateralism create the demand for international liquidity. The international liquidity demand is currently met through 3 sources. First is the official gold and foreign reserves of various countries, and the gold and foreign reserves of IMF and SDR, that's a special drawing right. It was introduced after the Second World War, and it is one of the most effective way through which the international liquidity is supply is maintained. And there are certain problems with the international liquidity after the Second World War. The reason behind that is the official stock of gold declined rapidly. With that is official stock gold of US declined rapidly, and along with there is a deficit in the US balance of payment. These two did more damage to the prestige of US dollar, and in that situation the international liquidity growth become so difficult. So many economists come with certain proposal and for raising the international liquidity, and first proposal is raising the price of gold, and that was proposed by Charles Lee Gale. According to him, the raising the official price of gold is very much necessary for solving the problem of international liquidity, and at that time the price of gold was 35 US dollar, and he want that to be increased to 42.2 US dollar, that is in 1973. But there was a problem, that is the major gold stock belongs to 3 countries only, that is USA, South Africa, France and USSR. Okay, so that plan was not acceptable and by many of the countries, and that leads to the failure of that plan. So that plan was not taken, right? So now we are for the second proposal, that is known as BRENSTEIN plan, and according to Bernstein, he was an executive director of IMF, and according to him, 96 countries that are under IMF should subscribe the debentures from rich countries like USA, UK, France, West Germany, Canada and Japan. So that was his proposal. It should be utilized for solving the problem of balance of payment. So this theory was known as IMF borrowing scheme, but as a whole this plan was not able to solve the problem of world liquidity. So the second plan by Bernstein, and he was an executive director of IMF, and according to that plan, the countries who are the members of IMF have to subscribe the debentures from richest countries like USA, UK, Japan, etc., and that should be utilized for solving the problem of balance of payment. But that plan also didn't work. Now the third plan, that is Robert Truffin plan. After Robert Truffin plan, that was in 1958 to remove the problem of international liquidity. So under this plan, the member countries are either required to deposit their currencies in the central bank or to transfer their foreign exchange reserve from the bank. So according to TRIFFIN plan, there is a need of a central bank, and that TRIFFIN wants IMF to act as a central bank for all the countries, and all the countries have to deposit their currencies in the central bank. So this plan also suffers a drawback, that is none of the countries was ready to surrender their foreign exchange reserve to the proposed World Bank. Okay, so that plan also was a flop. So are some of the proposals for raising the international liquidity. Okay. Now the second question, what are the objectives of IMF, how it's work, and how the IMF solved the international liquidity problem, then what are special drawing rights. Okay, so first we are going to discuss the objective. Objectives include foster global monetary cooperation, secure financial stability, then facilitate international trade, promote exchange stability, promote high employment and sustainable economic growth, and reduce poverty around the world. Now the working of IMF. So the first one is determination of quotas. Okay, so each member country is required to subscribe an amount equivalent to its quota, and it's the quota on which payment obligation, credit facilities, and voting right of the members are determined. Okay, so when a country joins the fund, it is assigned by a quota that is expressed in special drawing right, that is SDR. Capital subscription or quota is now made up of 25% of its quota in SDR or widely accepted currency. SDR is special drawing rights or in or widely accepted currencies such as US dollar, euro, yen, or the pound sterling. Okay, instead of gold, and 75% in countries own currency. So previously it was in the gold. Now the capital subscriptions 25% should be in SDR or in widely accepted currencies like US dollar, yen, or pound sterling or euro, and remaining 75% in the countries own currency. Right. Second point is determination of par value or exchange rate. So until early 1970s, the par value or exchange rate in the IMF system were determined in terms of national currency's parity with the gold. Okay, so if a country is facing some fundamental disequilibrium in the balance of payment, that country can revise its value of currency in terms of other currencies or gold. Okay, and that should be done with the guidance of IMF. And for determining the exchange rate, the country can choose a method, and that method include free float method, managed float, pegged exchange arrangement, or fixed exchange arrangement. So free float is in which the exchange rate of a country's currency is determined by the supply and demand of that currency on the international currency market. Right. The managed float in which the country's monetary official will intervene in the international currency market occasionally, either by buying or selling its currency for regulating the short-term exchange rate. In pegged exchange rate, the country's monetary official pledges to tie their currency exchange rate to another currency or a group of currencies. Okay, then another way is fixed exchange rate, that is country's currency exchange rate is tied to another currency but it remain unchanged. So these are the different ways through which the determination of exchange rate is happen. Okay, then after losing its authority to regulate the currency exchange rate, IMF shifted its focus from that to loaning money to the developing countries. Okay, so you have to remember the different exchange rate determination method: free float, then managed float, then pegged exchange arrangement, then fixed exchange arrangement. Right. Okay, the last one is borrowing from the IMF. Members with a balance of payment deficit may borrow money in foreign currencies. They can repay that amount with interest by purchasing with their own currencies the foreign currencies held by the IMF. So each member may immediately borrow up to 25% of its quota in this manner. Okay, the amount available for purchase was denominated in the special drawing right, that is SDR, whose value is calculated daily as a weighted average of 4 currencies. They are US dollar, euro, Japanese yen, and British pound sterling. So SDR means special drawing rights are an international reserve asset. It is created by IMF after the Second World War for to supplement members' existing reserve asset for foreign currencies and gold. That is, for supplementing the international liquidity, SDR was adopted after the Second World War. So it is an international reserve asset. So the countries use these special drawing rights that has been allocated to them by the IMF for settling the international debt. So these are the way through which the IMF working is happening. What do you mean by SDR? So SDR are one of the way through which international liquidity problem can be met. Okay, due to the growing demand for the international liquidity, IMF has created a new reserve asset after the Second World War, and that is known as SDR, or special drawing right, and it is actually a bookkeeping entry that at the IMF in account of member countries and IMF itself. They are not directly usable. They can be converted into national currencies before they can be used for meeting foreign debt obligations. So they are created in small quantities and have been allotted to member countries in direct proportion to their quotas. So as per the current scenario, SDR account for about 5% of the international liquidity, and the value of SDR has been fixed on the base of currency basket, that is a composition of currencies of world 5 largest exporting countries like Japan, USA, okay, Japan, USA, Euro, etc. Right? Then next question is determine the objectives and functions of World Bank. So at Bretton Woods conference in 1944, two organizations came into existence. First is World Bank and second one is IMF. So IMF and World Bank are twins or sister concern. The IMF and International Bank for Reconstruction and Development, that is IBRD, so that was referred to as World Bank. So World Bank started its operation in 1946. The main purpose of World Bank was to promote long-term foreign investment to help in transforming the war devastated economies, and also for encouraging less developed economies to accelerate the pace of the development. So these are the important objective of World Bank. Okay, now we are going to discuss the objectives of World Bank in a detailed manner. So this include provide long-term capital to its member nation, inducing long-term capital for improving the balance of payment and thereby balancing international trade, helps by providing guarantees against loans granted to large and small units and other projects for the member nation, ensures the development projects are implemented, and it also promotes the capital investment for member nation by providing a guarantee for capital investment loans, and if the capital investment loans is not available, then it provide a guarantee, and then the IBRD provide loans for the promotional activities on specific conditions. So these are the objective of World Bank. So World Bank comprises two institutions managed by 188 member countries, the International Bank for Reconstruction and Development and International Development Association. So World Bank consists of two organizations. First is IBRD, that is International Bank for Reconstruction and Development, and IDA, that is International Development Association. IBRD's aim is to reduce poverty in the middle income and credit-worthy poorer nation. Right. Then the IDA, that is International Development Association, focus exclusively on the world's poorest countries. Right. So you have to learn at Bretton Woods two organizations came, IMF and World Bank. Okay, World Bank is IBRD. It is often termed as World Bank, and IBRD and IDA are the two organizations coming under World Bank. So the focus of IBRD is to provide so that it can reduce the poverty in the middle income and credit worthy poorer countries, whereas IDA, that is International Development Association, focus exclusively on world's poorest countries. Right. Now the functions of World Bank. The first function is lending and guaranteeing private loan. So that is the first function. It provides loans to member countries either through loan out of World Bank resources. From the World Bank resources itself, they will provide the loan. Then another one is they borrowed resources and then provide loans to the countries, that the member nation, and the last way is the on the guarantee of World Bank the loans are provided. Okay, so second function is technical assistance. It helps the war devastated countries by granting the loan for reconstruction, and it helps underdeveloped countries by granting development loans, and it provides economic, monetary and technical advices to member countries for their project. Okay. Now the third one is stimulating foreign investment. It encourages the development of industries in underdeveloped countries by introducing various economic reforms and direct foreign in private foreign investment. So if a private foreign investment happens, so it can avoid fixed interest rate and easily technical advices are available. So these are the functions of World Bank. Now the next question is, what do you mean by foreign exchange market? Distinguish between spot and forward exchange market. So foreign exchange market, in a narrow sense, it refers to foreign currencies. So in broad sense, foreign exchange includes not only foreign currencies but also bank deposit. Okay, it is denominated in a foreign currency, and short-term claims on foreign exchange foreigners expressed in foreign currency. So the main participants in foreign exchange markets are retail customers, commercial banks, foreign exchange brokers and central bank. So retail customers means individuals and a business firm that whenever we have a dollar with us, so if we want to convert it to Indian rupee, so we are retail customers. They buy or sell foreign currencies either for transaction purpose or adjusting their portfolio. Then commercial bank. So commercial bank is also considered as a important institution that is operating in the foreign exchange market. While we discussed the commercial banks and its operations and functions, we discussed about the foreign exchange rate and all. And commercial bank hold foreign exchange inventories so that it can enable them to transact in foreign financial currencies with their retail customers. So if you want to convert a foreign currency, you can approach the bank too, right? Then foreign exchange brokers. In certain countries like USA, commercial banks do not transact in foreign exchange directly with the customer, and they usually acquire the service of foreign exchange broker. In USA it is there, but in India commercial banks are in the market, in the one of the service providers. Then central banks. A country's central bank is an important participant in the foreign exchange market that we discussed under the function of central bank and function of RBI. We discussed about the role of these banks in the foreign exchange market, and foreign exchange is completely controlled by RBI in India, and its activity is guided by mainly two purposes: to support the domestic currency in the foreign exchange market and to regulate the amount of country's foreign exchange reserve. Okay, so these are the important things you have to remember under foreign exchange market. Okay, what do you mean by foreign exchange market, and what are the or who are the main participants in the foreign exchange market? Now we are going to discuss the differences between spot and the forward foreign. So spot market means if the operation is of daily nature, that is exchange is happening is of a daily nature, it is called the spot market or the current market. So today I have $10 with me and I want to exchange it to Indian currency. So depending upon today's exchange rate, that transaction is happening. So that is spot market. Handles only the spot transaction, the current transaction in foreign exchange. The exchange rate that prevails in the spot market is called the spot rate. Spot rate of exchange refers to the rate at which foreign currency is available on the spot, not quoted in premium or discount, and have no specified reason. Now go to forward market. But in a forward market in which foreign exchange is bought and sold for future delivery is known as forward market. Okay, so I have to exchange same $10 but in future only. Okay, so it deals with the transaction which are contracted today but implemented sometimes in future. So exchange rate that prevails in the forward contract for purchase or sale of foreign exchange is called forward rate. So today's I want to exchange, I am going to exchange the $10, but that exchange will actually happen after 1 month. Okay, so that rate, so the rate applicable for that type of transaction is known as forward rate. Forward rate is the rate at which the future contract for the foreign currency is made, and it is quoted in premium or discount. Okay, so minimize the risk or loss or risk of loss due to the adverse change in the exchange rate. For example, today the exchange rate is 45 rupees, for example. Okay, so I will get that 45 rupees today, but after 1 month it can be 55 rupees or it can be 40 rupees. Okay, if it goes below the 45 rupees of today, it will be a loss for me. Okay, so for avoiding this uncertainty and for minimizing the risk of loss due to the adverse change in the exchange rate, forward marketing is the best one for future transactions, right? For making the future delivery and to make profit. Okay, that is speculation, right? So that is the basic difference between spot and forward market. These are coming under foreign exchange market, right? So we discussed some of the important questions from block number 4, that is these video covered block number 4 important PYQs. In the next video we will cover block number 3 important PYQs. Okay, so you have to withstand a storm, and we all are passing through a storm, but our boats are different. Only thing that can help us to withstand this storm is resilience. Okay, so be resilient to all the storm and all the changes that are happening in our life. Okay, with that note, we are going to wind up this video. So if you like the content, please like, share and subscribe, and if you have any comment, please do comment in the comment section. So welcome with the next video. Till then, it's bye, take care, stay safe, stay healthy.